They say more millionaires are made during a recession than any other time period. And in this video, I'll show you 5 different ways to invest during a recession so you too can be on your way to become a millionaire one day. If you're a new investor who started investing in mid-2020, then you've never experienced a recession before. So if you are feeling scared about the current state of the market, then don't worry, because today I will give you 5 different strategies you can implement to take advantage of a potential recession. People naturally think of a recession as something scary, so when stock prices go down, they get spooked and start panic selling their entire portfolio. Then the next person does this and so on, which creates a downward pressure in the stock market. This is a big mistake and I want you to avoid doing this. Because if you are a long-term investor with decades ahead of you, then it is actually a great opportunity for you to take advantage of the short-term pain in the market. By the end of the video, you'll have a clear understanding of the different options you can take so you can create a plan to not only survive but thrive during this recession. So if that all sounds good to you, then let's get started. The first strategy you can do is to continue to dollar cost average into index funds. Dollar cost average means to regularly buy stocks spaced out over regular intervals. So it could be every week, fortnight, or month after you receive your paycheck. The idea is to completely ignore the price of the stock and continue to purchase over the long term so you get the average price of the market. So it doesn't matter what price the stock is, if it's time to buy, then it's time to buy. An index fund is a portfolio of stocks designed to mimic the performance of a particular financial market index. The most popular one being the S&P 500, which consists of the top 500 US companies. In fact, Warren Buffett himself recommends the average investor to buy index funds because over the long term, 99% of professional active investors fail to beat the index. So rather than spending time reading various stock charts and financial reports to pick individual companies, it is much better to just buy the index. Over the last 100 years, the S&P 500 has returned 8 to 10% per year on average. If you're in Australia like me and you're not interested in the US market, then there are a few index funds that track the Australian stock market, and they have historically returned a similar 8 to 10% per year on average. The easiest way to invest in index funds is through an ETF. An ETF is just like any other stock with its own ticker symbol, and you can find it in your favorite brokerage. If you're interested to learn more, I have a video where I explain it in more detail, and I'll link it down below. Dollar cost averaging into index funds is a proven strategy for many investors who don't want to deal with the stress of trying to time the market or keep up to date with the financial news. Instead of worrying about when's the best time to buy a stock, you can just put some money aside from every paycheck and dollar cost average into index funds through rain, hell, or shine. The best part of this strategy is you can implement it in any type of market condition, whether we're in a bull or bear market. It takes the stress completely out of investing and it will free up a lot of your time to focus on other important things. The second strategy is to buy the dip. Over the long term, the stock market has always gone up. That is a fact. So during a market downturn, you are presented with an opportunity to buy stocks at a discounted price from their previous highs. But if you are a long-term investor who is planning to hold onto your stocks for the next 10, 20, 30 plus years, then it may make sense to buy more when the stocks are cheaper. But of course, the risk in buying the dip is it can dip lower. In the current climate, inflation and oil prices are still quite high and they could get higher if they are not controlled. There are also global political issues and supply chain shortages which may affect the short term. So if you are a short-term investor, a swing trader, or an options investor, then this strategy probably won't be appealing for you. However, if you're a long-term investor with decades ahead of you, then this could be an ideal time to buy more at a lower price. I mean, think about it. If you are happy to buy your stocks or index funds during the biggest bull run in the last 10 years when prices were at the highest, why would you not want to buy these same companies when prices are much lower? All the good companies in the stock market are coming down in price not because they are bad companies, but because there are external factors like high inflation, high interest rates, and other short-term issues that are dragging down all the good companies along with the bad ones. In the long term, all the good companies will continue to make profit and return back to new highs. If you are buying index funds, then usually the good companies are already selected for you, and if they don't perform, then they are automatically kicked out and replaced with a new better company. Also, if you have high conviction in some growth stocks, now might be a good time to buy them at a lower price since growth stocks generally do not perform well during a recession. However, if you believe in the company and you're willing to hold them for the long term, you'll be able to sell them for a higher profit if you buy at a lower price. It's just simple economics. They say the time to buy stocks is when there is blood on the streets. Right now, it's looking very bloody outside. Sometimes I feel a lot of new investors have the wrong mindset on when to buy. The aim of the game is to buy low and sell high, not the other way around. Warren Buffett has a famous quote, "Be fearful when others are greedy and be greedy when others are fearful." By this he meant you need to be brave enough to go against the grain when investing. When everyone is piling into the stock market, that is when prices get inflated and eventually will return back to its intrinsic value. This is not the time to be buying. On the other hand, when everyone is fearful of a recession or other short-term events, that's when prices come tumbling down and should eventually return to its intrinsic value once these short-term events disappear. This is the time to be buying. The third strategy is to just hold and do nothing. If you are already invested in the market, then just leave your stocks there and do nothing. This may sound like a lazy approach, but in actual fact, it's one of the most effective. Some studies show that people who have made the most gains in the long term are the ones who forgot they invested and left their portfolio alone to grow over time. I think this could be a good strategy during a recession recession because the media will be fear-mongering every day with news that the world is coming to an end and everything is going to zero. Unfortunately, that's just how it works. Fear sells and the media know this, so every day they will post a new article that evokes people's emotions. In this age of smartphones, clickbait titles, and sensational headlines, it's very easy to get emotional when reading negative stories day after day. I've been investing for many years and I still get a bit fearful sometimes when reading these headlines, even though deep down I know it's mostly exaggerated. And as we know, emotions is one of the biggest enemies when it comes to investing. Fear can cause you to make rash and illogical decisions. When everyone is telling you the world is ending, it's easy to get tempted to panic sell and end your pain. However, the best investor is the one who can remove the emotions from their decision making. So if you are an emotional investor, and don't worry, every new investor is emotional at the start, then the best thing you can do is to delete your investing app and don't pay attention to the news. Just continue to enjoy and live your life. Let the market do its thing, because historically, market volatility is temporary and it usually goes back up in the long term. The fourth strategy is to buy into dividend stocks, otherwise known as defensive stocks. These are well-established companies that regularly share their profits with shareholders through dividends. These companies tend to be both consistently profitable and seek to continue paying dividends for the foreseeable future. The defensive sector that does the best during a recession is consumer staples. For example, Walmart and Costco in the US are consumer staple stocks. If you're in Australia like me, then Woolworths and Coles are good examples. Generally, these types of stocks do well during a recession because their stocks are considered essential to everyone, regardless of their financial status and the shape of the economy. Humans will always need food, groceries, and other household and personal care products. It doesn't matter how good or bad the economy is, the demand remains the same because, well, everyone's got to eat, right? So this is why consumer staple stocks are often favored by risk-averse investors that are looking for safer returns and dividends with low volatility. The fact that they pay regular dividends help to mitigate any volatility in the stock price. In fact, according to studies, in the last 4 recessions since 1990, there were only 2 positive sectors in the S&P 500, and they were consumer staple and healthcare stocks. This is obviously not financial advice, but if you are interested in investing in dividend stocks, then please do some more research and understand the risks involved. Just because it's considered safer does not necessarily mean there are no risks, so please do more research if you are interested. The fifth strategy is to diversify into other assets. Yes, we love stocks on this channel, but there are other assets you can invest in during a recession. For example, you can look at real estate, cryptocurrency, and even your own business or side hustle. People are less likely to spend during a recession, therefore you should keep an eye on real estate in your area. If you have some cash on the sidelines, then you can pounce on any potential deals that come your way. And given that the real estate market has been in a huge bull run in the last decade, and especially in the last few years, a recession may be a blessing in disguise if you're one of those people with a down payment saved up but couldn't get into the market. It's certainly hard to find good real estate deals during a boom, but it will be easier during a recession where it will be a buyer's market. This means purchasers have an advantage over sellers in price negotiations. Real estate is one of the best investments you can make, as generally speaking, it does tend to go up in value over time. It's also a good source of passive income if you can find a good tenant and rent it out. So keep your eyes open for any potential good deals. Cryptocurrency is another asset class you can look to invest in during a recession. But please remember that crypto is still a new asset and as such is very risky. During the good times, it will outperform stocks and real estate, but during the bad times, like during a recession, it will do the opposite. However, if you believe in crypto, then a recession is the best time to buy while the prices are low. Check out this meme that shows the psychology of people. We always tend to buy when it's high because everyone else is doing it, when in fact it's the ones who buy when it's low that will profit later on. If you are a beginner to cryptocurrency, I would recommend you first do research on what they are and what value they bring so you have a clear understanding of what you're investing in. The worst thing you can do is blindly invest in crypto because you heard it keeps going up from your colleague at work. I would recommend starting with Bitcoin and Ethereum as they are considered the blue chip cryptocurrencies and are the 2 most likely to survive in the long term. Personally, I think cryptocurrency is the future and mass adoption is inevitable. However, we don't know how long that's going to take, so please keep that in mind. You can also invest your money on your business or side hustle. During a recession, cash is king, so if you have some money saved up, then now is your time to negotiate a better deal from your suppliers. You should take full advantage of your negotiation power by renegotiating your prices so you can increase your profit margins. That way, when the economy begins to do well again, so will your business. And there you have it, my friends. These are my 5 investing strategies you can implement during a recession. But now I want to hear your thoughts. So please leave a comment down below what strategy you plan to implement during this upcoming recession. And as a final note, I just want to say the most important key lesson here is to always stay invested. Trying to time the market is something a lot of new investors try to do, and believe me, it's not worth the stress. The moment you think you know how to beat the stock market, something will happen to show you how unpredictable it is. Respect the stock market, but do not be afraid to take action and change your strategy depending on market conditions. I hope you enjoyed this video, and if you learned something, then please give it a like so it can be shared to more people. Also, don't forget to subscribe to my channel so you don't miss any future content. And in the meantime, I think you'll enjoy these videos, so go check them out. And until next time, my name is Brian, and I hope you make a lot of money.